Welcome back. Consumer inflation has risen to 4.5% year-on-year from 4% the month before. That's according to Statistics South Africa's CPI index for March. An increase in the price of food and petrol in the March to April period was the main driver of the latest inflation figure. So the rise in prices reflects the tightest squeeze on the pockets of consumers. But it's also an important consideration for the Reserve Bank, which this week decides on interest rates. The bank's Monetary Policy Committee is probably going to upwardly revise its inflation outlook now that the oil prices are slightly higher than in March, and that price sitting at $64 a barrel, while the rand has remained weak. Well, joining us this afternoon, Elise Kruger, economist at CAD Capital. Elise, good afternoon. Thanks for coming in.
Afternoon. At
4.5% consumer inflation, it's pretty much in line with expectations.
Yes, on the day the figure is in line. We expected about 4.6%, but there was a slightly lower food price inflation number than what we thought would materialize today. But the main driver on the day was the big petrol price rise that we've seen in April. And you'll recall that it was halfway due to the government's increases in levies. The fuel levy that increased by 30 cents per litre and road accident fund levy by 50.5 cents per litre. So that was about half of the overall price increase, and the rest was indeed, the high oil price and the weaker rand exchange rate that still had a negative impact on fuel prices in April.
And the outlook is what we're interested in here. Now, in March, the Reserve Bank says they expect inflation to stay within that 3 to 6% target range, at least for the rest of the year. But you look at those drivers, petrol, fuel, and food to some extent. Does that outlook still stand, you think?
Well, I think the outlook has actually deteriorated, not so much the factors you mentioned, but rather the electricity tariff scenario. I mean, as you know, we're expecting this to tell us on 29 June whether they're going to award to Eskom another 12.61% on top of the 12.69 we already know we're going to pay higher for tariffs from 1st of July. So if you add that extra, it's going to significantly up the forecast curve of CPI. But already, even in June, we expect now about a fuel price increase of about 50 cents per litre. That was not known info at the time of the previous MPC meeting. So I do foresee they're going to up their forecast anyway, despite no new info on Eskom yet until the 29th of June. But I am concerned, that already without additional electricity tariff increases, our forecast suggests that we're going to see a peak at about 7.4% in February next year. And, we know the bank is forward-looking, and they always say they're 12 to 18 months forward. And, if you currently look at that scenario, we're going to peak at 7.4, and, the tail down, depending on how high it will go, will depend on the average. And we are looking already at an average of about 6.4% for 2016. Now, that is a concerning scenario, especially with the governor coming out last week, sort of very black and white, saying, if it's sustainable above 6, they will act. If it's temporary, they will ignore. And at the moment, their view is still temporary above the target band just in Q1. But that, I'm afraid, is going to probably have to be revised.
All right, let's talk about the governor now. I mean, the MPC meeting is considering what the inflation data said this week, and more importantly, the outlook. The repo rate standing at 5.75. Of course, if you're lending from a bank, 9.25% is the prime lending rate. If we do see a move in interest rates, it's more likely that we'll see a hike before a cut. Is a cut out of the question in the medium term?
I think a cut is definitely out of the question. Number one, looking forward on the CPI outlook, it's rising. The extent of the rise will depend on electricity tariffs to a large extent, and obviously the oil price as well, and the rand and so forth. But, the fact that the curve has moved higher and that the 3.9 we've seen 2 months ago was a lower turning point, I think that's indeed a fact. So from here onwards, inflation will be rising. On the other side, growth is low. So I think we could rather argue between unchanged interest rates and, the timing of a potential hike. But the cut, in my view, is completely out of question.
What do you think will be said this week from the MPC as far as growth is concerned? We're hovering around that 2% mark. What do you think the words would be on the growth front?
I think they're going to maintain by saying that the growth environment is still sluggish and it remains a source of concern for the bank. Because if you look at the data that's out for the first 3 months of this year, it's been pretty mediocre. I mean, we've had a bit of a better mining figure, but, manufacturing has been a drag on growth. And, depending on how the combination of all those are together, we forecast in the quarter-on-quarter growth rate in the order of about 2% compared to the fourth quarter's 4%. And, the table is laid for a maximum of 2% for this year. I think if we're lucky, because it could even be lower, given all our constraints on electricity supply and so forth. So I think, with this type of levels, it's below potential. The bank doesn't really have the opportunity to aggressively, normalize rates, but they want to start to normalize rates again. And I think the inflation outlook might just give them the justification to maybe start again with the interest rate cycle. But I don't think at this meeting, but maybe sooner than what we thought initially after this week's meeting.
Elise Kruger from CAT Capital, thanks for coming in.